Hello, everybody. Welcome back to the Finspire's Focus on the Market series. Hey, it's third quarter 2024, and we're going to jump in not just what happened in the first half of the year, but also look ahead towards the rest of 2024, which has a lot of things in store for us, things that we think are coming, things that we didn't plan on occurring at all. And this is the Olympic edition, so we're going to get very prideful here of Team USA going into Paris and competing in the Olympics and seeing how they fare. So we're going to root them on. And so we've got a few Olympic level trivia questions for you along the way, as well as some interesting tidbits about the Olympics as we know them today. So let's jump into it because we've got a lot to cover. All right, let's first take a look at our capital market strategy board here. So as we look and digest what happened in the first half of the year, what do we notice about the economy? The economy, yes, it's slowing down, but it does appear that the recession that was predicted a couple of years ago, will it come? Could it come? Yes, but it seems less and less likely. It seems more like we're in this period of slowing economic growth, but positive economic growth. And that could be good, and one of the reasons why the equity market did so well in the first half of the year, but not all equities. We'll talk about that in a moment. A growing but slowing economy still favors stocks over bonds and cash. Although it's certainly something that we're going to watch closely with the next GDP output report, which is going to come next week. And it's still important to remain diversified. Look, the first half of last year, diversification didn't do that great. I think you'll see here in a moment that having a diversified portfolio was okay in the first half of this year, but not great. But in the second half of last year, that diversification really helped out, and I think we're going to get that again in the second half of this year, and I'll share why. Okay, the markets. Great overall index level results in the first half in the S&P 500. The Magnificent Seven stocks are really what are driving, what drove results in the first half. Our last quarter video was all about artificial intelligence. That continued throughout the second quarter of the year. And that led to many record new highs on the S&P 500, largely due to those growth stocks outperforming everything else. But that may not continue to happen and to occur in the second half of the year. Doesn't mean that growth stocks are doing poorly, but there are value opportunities out there. And watch for things like the US dollar running out of its strength. We saw that last year. We see that happening somewhat again here, which could lead to a better second half of the year for, say, international equities, small companies, and also with gold and silver, which we'll talk about a little bit later on in the presentation. Politics. I know that it's been a tumultuous month of July, the assassination attempt on President Trump, but it's a lot more than Trump and Biden. In fact, it appears that Joe Biden, as we speak, has dropped out of the race. And there's going to be a huge emphasis on congressional control, which is going to become much more in focus. That was one of the concerns about the House and Senate candidates coming out and incumbents coming out and saying, look, we need to make a change here. Otherwise, we're at risk of losing the House and Senate races. So those are going to come back into focus in the second half as the Democrats figure out exactly who their nominee is going to be. Interesting perspective from a market reaction. Because those probabilities for seeing Trump to win re-election were so high going into and up into and after the Republican National Convention, the markets were anticipating this, as they always do, and applied what we're calling, quote unquote, the Trump trade. And this is something we saw in 2016. It lasted about 3 weeks. It lasted about 3 weeks after President Trump was elected in 2016, and it favored the traditional value sectors like energy, financials, materials. That actually has started to take place in the equity markets in the month of July. But what's interesting is that throughout the entire first President Trump term, it actually were technology and communication, some of the growth-oriented sectors that did the best over his four-year period. So will this particular Trump trade that's taking place in this July that has favored more value sectors, will that also translate into better results down the road for technology, communication services, consumer discretionary sectors like we saw in 2016 going into 2017. Not certain this time because we do appear to be in a little bit more of potentially a cyclical value rally, but it remains to be seen. But we are tracking the similarities between Trump's election in 2016 versus the anticipation of another Trump victory in the markets in the month of July of 2024. However, like I mentioned, it's basically a new race now, effective today. So that markets may have to reset themselves based on the new candidates and the new nominees essentially in the race. It's going to be a fun time here in Chicago. If you want to come join us, there's a lot of parallels being drawn in 1968, but we'll talk about that a little bit later on. Okay, I mentioned new all-time highs in the equity markets in the S&P. It's good to be in that index, which has concentrated positions at the top of it. 31 new all-time highs in the first half of the year. And you can see the S&P with that sort of golden arrow or line pointing higher. That equated to 31 new all-time highs. That was largely driven by the performance of a handful of stocks, which I'll show you in a moment. But the S&P 500, you can see 15% really led the way by a large margin. So emerging markets actually had a great end of the second half of the quarter. And the emerging markets up 7.7, a balanced portfolio, still real positive, right? Still a very positive first half of the year for investors, 7.2%. And that's with fixed income delivering effectively zero. And small caps were only about 1.7% to end the second quarter. July, it's been a much better month for small companies. We'll see if that continues. You'll notice that there's some events here, Olympic event emblems. And I took some that I really had no idea about. And this one actually is the symbol for an event called the canoe slalom. I had never heard of it. I thought it was really interesting. So it's not just regular canoeing, but the canoeing slalom event. So kind of an interesting emblem. If you see that on TV when you're watching the Olympics, I think that might catch your eye. Okay, I mentioned the Magnificent Seven. The Magnificent Seven stocks really since January 2020 have driven the main portion of growth of the S&P 500 index. Not just of the S&P, but also of the NASDAQ, which is typically a more tech-heavy index, a tech-heavy stock exchange. You can see this. Look at this. Magnificent Seven, 386%. If you just were to take a weighted performance of the seven stocks here, Meta, Amazon, Apple, Alphabet, Nvidia, Microsoft, and Tesla. And actually was with Tesla not doing that great over the past 12 months up until the last few weeks. Nevertheless, the darling of the stock market, if you will, has been Nvidia with its extraordinary triple-digit returns. And you can see that just those seven stocks, which are amongst the seven largest stocks in the S&P 500, you can see just how much those have outpaced and carried the rest of the trading indices, such as the NASDAQ stock exchange or the S&P 500 index. These really stand out, and they're really something. All right, check this one out. It looks like a track and field, but this is an event called Athletics. That's the name of the event, just athletics. So I'm eager, just like anybody else, to see what's in the athletics event, because it appears to look like a track and field type. Maybe it's a heptathlon or a decathlon or a pentathlon type thing, but I'm eager to find out. We'll find out soon enough. All right, economic activities, indices. We've looked at this several times over the last several quarters, how there's been a big disconnect between the services sector, or also known as the non-manufacturing, which is here in the gold line, and then the manufacturing growth, which has actually been shown to be in contraction for the last several quarters. Those historically have eventually caught up to each other, moved in sync with one another, but not so post-COVID. So when we looked at the last few years, one of the reasons why there has not been a recession is because the service activity or the non-manufacturing activity has remained in expansionary territory. Anything above 50 or this dotted line is expansionary, anything below is contractionary. So although manufacturing is contracting and being a drag on economic progress, services sector, which is becoming a greater share of the U.S. economy, is, however, still in expansionary mode, and that's really what's driving the favorable, positive economic growth. And this actually, the symbol here is the Olympic event of fencing. So we all have watched fencing, but I pictured this services and manufacturing as sort of in a fencing match where they're trying to see which one's going to be in expansionary, which one's going to be in contractionary territory along the way, because we're still getting these very disconnected results in the economy, and it's one of the reasons why there was so much prognostication about a recession. But these have not yet decided to move in sync. You can see they're actually somewhat uncorrelated with one another over the last few years. All right, let's look at unemployment wage growth. So big stories here, and this really contributes to the inflation story. It contributes to a lot of different economic themes that you're seeing. It also plays into the Federal Reserve, how they've used interest rate hikes in order to tame not just the economic growth, but inflation. And they said they were going to try to do it with impact, but with minimal impact to the labor market if they could. And it appears that up until this point, that is really what's happening. So we'll look at the inflation figures in a little bit. Those have just continued to inch downward just a tad. But with this wage growth, the unemployment rate picking up to 4.1%, is a big deal. It's up from the sort of the mid threes where it was about a year ago, and wage growth has fallen to about a 4% wage growth level, which is something a little bit more in line with a slower inflation type economy. So the Federal Reserve so far has had a blunt instrument of interest rates and using that to try to correct some of the excesses of things like inflation, and perhaps limit the amount of job growth in the economy just to slow it down a bit. I know it doesn't sound great, like a great idea, but they've really approached that had to thread a needle. And so for this, I'm going to throw you an easy one here. This one, as you might imagine, is archery, this Olympic event. And it does appear that the Federal Reserve has hit the right mark here. However, there are some concerns now. Of course, you can never win, right? The concerns that when they do go to cut interest rates, maybe it will be too slow to react to an economy that is starting to slow down. Time will tell, but it does seem like they've done their role as a Federal Reserve Committee to control things like inflation and not let the labor market spiral out of control. Okay, let's look at valuations. This is something we have not looked at in the past. This is showing the spread. I mentioned how strongly the performance of the Magnificent Seven stocks, which are primarily in the growth sectors as opposed to the value sectors of the markets. And if you look back over 20 years, we haven't seen this level of spread. When you look at valuations, across what's called the Russell 3000 growth. The Russell 3000 is a barometer of all large cap and small companies in the tradable universe in the United States. And you can see today growth, or as of the end of the quarter, I should say, growth was the valuations on growth stocks were 9.6 times that of, or I should say the spread of growth valuations of 9.6 times from a price to book ratio versus value stocks of 2.2 times price to book ratio is above over two standard deviations above. That 7.4 times spread is 2 standard deviations above the historical average, which you can see here. Historical average is 3.2 times. So there's usually, because growth stocks have higher earnings per share growth, there's usually a higher multiple paid on when it comes to things like price to book ratio or price to earnings ratios on growth stocks as there are to value stocks. But even adjusting for these valuation metrics, the spread is 2.1 standard deviations above the average. Now, what does that mean? So for those of you who weren't in statistics class or don't know exactly what that means you're approaching basically only less than 5% of the time does this occur in market history. And so that's what the 2.1% standard deviation, or 2.1 standard deviations away from the average really means, is that this occurs in essence in very few circumstances, at very few times in market history. We just happen to be in one of them today. So what I use for this symbol here, what do you think this is? This is actually, and I did not know this was an Olympic event, this is the symbol for surfing. So pretty cool. So surfing is an Olympic event this year. I didn't know that. Maybe it was last time. I just can't recall. But I'm looking at this growth valuation wave and looking at a huge wave to ride for these surfers, for a market surfer, looking to hit the crest at the right moment. So we'll see if that happens. All right. Because of that, as you might imagine, we've got this opportunity, if you will, in valuations with value stocks. And if you look at the contrast, now we've looked at this style of a chart in the past where you have earnings per share growth in the bars, the diamonds represent the next 12-month forward-looking valuation or PE ratio. So in short, what you want are really tall bars and really low diamonds. And when you have that disconnect of having a really tall bar and a really low diamond, that creates the best relative opportunity in the markets. So as you can see here, because large cap growth stocks have done so well, they also have very high earnings per share growth, as I mentioned a moment ago, but their valuations are also quite high. Well, guess what also has high earnings per share growth, but has a much lower valuation, and that's small cap value. Now, this actually puts real quantifiable figures to the numbers we just looked at in the last chart. Small value, small caps, as you saw earlier on, have really only performed about 1%, 1.5+% in the first half of the year. And we can see the markets are waiting for this rotation to occur, but it hasn't quite happened yet. There are some signs that it happened in the first part of July. We'll see. It'd be good to see that trend continue. What we do know is that the last time this valuation gap was as large as it was the year 2000. Now that was at the peak of the tech boom. There's a little bit of a difference today of tech stocks. Tech stocks today are much healthier from a profitability standpoint. They have large cash flows, which wasn't really the case in the year 2000. However, it doesn't mean that tech stocks and growth stocks are going to do poorly. It just means there's some catching up to do in the small cap value world. And we look back at 2000 to 2002, one of the better performing asset classes in the equity markets was small cap value. In fact, they outperformed the S&P 500 index over that 3-year period quite substantially. So we can see elements of that playing through again as more and more investors eventually look at these opportunities in the smaller cap space and in the value sectors, because you can only ignore those for so long. Okay, now what is this? This is a symbol. It looks like a soccer ball. And so at first I thought, this must be soccer or football, if you want to, depending on what part of the world you're from. But this is actually the symbol for handball. And handball is really cool. If you ever watch handball in the Olympics, I only get to watch it during the Olympics, because obviously it's not on television here very often. Really fun looking sport, but pretty wild to watch. But this is actually the symbol for handball. All right, quiz time, trivia time. All right, there is an Olympic motto. I didn't know that until I did some research here. It's Citius Altius Fortius. Now, what does that mean? What is the English translation of the Olympic model? Is it together, better, united, faster, higher, stronger, or slower, lower, and weaker? All right, maybe I think you can be able to rule one of those out. But it's actually faster, higher, and stronger. So I didn't know the Olympics had a motto. I'll talk a little bit more about that in a moment, because it's a kind of interesting story. All right. Let's talk about yields. Yields moved up a little bit. Just a little bit in the second quarter. Quarter over quarter, we've seen yields actually jump all around the place over short periods of time, and yields continue to be quite volatile. The interest rate market continues to be quite volatile, but we do see yields settling in between. I'll say the top line here, top line blue, and the lower level gold here. And somewhere in between here, it's been actually quite a tight range. Throughout the second quarter, we saw yields get as high as 10-year yields get close to that 4.5, 4.45, 4.5 range, only to be knocked back down closer to the 4.15% range. And this is just a reflection of all the different economic scenarios, the inflation scenarios that are being baked into the interest rate curve, yield curves here. But we still see great opportunities in interest rates, in bonds, delivering not only a good level of income, but also with the opportunity that if, or the diversification potential, I should say, that if maybe the economy underperforms in the second half of the year, will we see yields come down even further? And that could actually be quite a boon for total return levels for fixed income to be quite positive to finish the year. We'll see. But right now, these are pretty healthy yields, and for where you don't have to go out very far in the maturity curve, and you don't have to take a lot of credit risk while you're doing it. Now, here's the flip side of that coin, and this has been something that's been brewing. We've talked a little bit about the national debt, for example. Well, interest rates now have been far above where they were, say, 3 or 4 years ago. And as dollars and dollars, trillions and trillions have been piled up in deficits, that's translated to trillions and trillions being added to the national debt. Well, it's debt. So what do you have to do? You have to make interest payments. And look at this curve. So if you look at the projected interest payments, which are in blue here, and the projected interest as a percentage of the overall economy in the orange or the gold here, look at what happens. Here is where we are today, and you can see the expectations of almost a parabolic curve higher, of significantly higher interest on the debt because interest rates and yields have risen. And you also see that as a percentage of the overall economy rising. This is a big drag on the economy. It's also a reason why rates has remained elevated, why the yield curve has remained elevated, because eventually you have to auction off this debt to investors, and they're going to say, maybe I need a little bit of a higher interest payment. And that's really counterbalancing the argument that if we get a slowing economy, that yields will fall, or lower levels of inflation, yields will fall. On the other side of that ledger, you have debt rising and interest payments rising, and you have concerns about how or when that money is going to be repaid. So this is something to keep an eye on. This is going to be a big focal point. Now, this symbol here, check out this symbol. Now, I wasn't sure what this was, and I had no idea that this was an Olympic event, like a few others we've talked about so far. That's why I included it in the slideshow. This is for trampoline. So this is for trampoline. Trampoline is its own Olympic event. I can't wait to watch that, to see how high people fly off the mat there, so to speak, and some of the tricks they do. And if you look at what the U.S. government's going to have to do with a trampolining level size interest payments, they're also too going to have to do some acrobatics at the top here to figure out how to stem the tide, whether it's a function of slowing spending growth, getting inflation under control, et cetera. All will help, but it's going to be really up to the next year, to the Congress next year in 2025. All right, let's talk a little bit about politics. As I mentioned, it's no longer a Trump-Biden-Kennedy type race. It is a Trump to be versus essentially a candidate to be named later on the Democrat National Convention, most likely or potentially Kamala Harris, Vice President Harris. But things could change at the convention in Chicago in a few weeks. What I want to distill, however, is that markets have pushed higher in a variety of different blue or red versions of who's president. And we're not getting caught up in the blue versus red at the executive branch level too much, because we kind of know, as I mentioned earlier, the Trump trade that took place after Trump's unexpected election in 2016, the initial reaction of the market was actually polar opposite of what transpired over the next few years to come. So it's incredibly difficult to predict, even though we already have 4 years of President Trump to compare versus the last 3.5 or so with President Biden. The reality is that markets tend to find themselves higher in most circumstances. Markets tend to do well under a blue Democrat administration or red Republican administration. Few exceptions, right? You can see the flat line here or really what was considered to be the lost decade of stocks in the 2000s, as we not only came off the tech boom in 2000, but we also, of course, had the mortgage crisis, which really markets started heading south in the fourth quarter of 2007. And that all fell under George W. Bush's term. But you can see whether it's been Clinton, Reagan, Bush, Obama, Trump, Biden, markets have found their way higher. We actually think as interesting and concerning and interesting and newsworthy, of course, globally, the Trump-Biden race, or the Trump versus candidate to be named later race, is going to be the battle for Congress. Is going to really dictate things like tax rates, which are set to sunset in the end of 2025. It's going to be a big deal. And so next quarter, we'll take a look at the composition of the House and Senate and what that looks like, because that's really those are the races that are going to really start to crystallize later on in the cycle, in the election cycle. And so our next video will be about towards the end of October, right before election time, and we'll take a look at the makeup of Congress and the importance of that. But really, I couldn't think of a better image than just we are this is a very unusual time, and need a United States of America for sure. See our way through this very, very challenging time. Okay, now back to the Olympics. I mentioned that we'll have a few more things on Olympic history, because Team USA is about to hit the fields and the courts and the everything involved with competition. I have this gentleman's name here, Pierre de Coubertin. So he is a Frenchman who actually is known as the father, referred to as the father of the modern Olympic Games. And I found it interesting because with the Olympics in France this year, back with Paris hosting the Olympics this year, it was actually back in 1913 when the Olympic flag with the ring were created. And those rings represented the 5 inhabitable continents at the time. And so I found it interesting that that was the history of the Olympic rings. I find it interesting that a little over 100 years later, Paris hosting the Olympics, and it was actually a Parisian, Pierre de Coubertin, who actually created the flag and also helped create that motto we talked about earlier. And so it's a little tidbit of Olympic history that maybe not all of us knew. But that being said, despite all the modifications being done in France, we are voting and hoping for the best for Team USA. Putting ceremonies are getting off in about a week or so, and all the events will start, of course, at that time. So go Team USA. Thanks for listening. We'll talk to you again real soon. Thank you.